Hello traders! Welcome back to our channel, where we'll give you the best tips and tricks to help you succeed in the world of Forex trading. Today, we're going to talk about the best free Forex trading indicators and how to use them to increase your chances for profit. If you haven't already, please subscribe to get more resources. You can even send a quick email to connect with us. We're looking forward to hearing from you. The first indicator we are going to talk about is the Relative Strength Index, or RSI. This indicator helps you identify conditions where an instrument is overbought or oversold in the market. More specifically, the RSI is a momentum oscillator. The momentum of the RSI will oscillate between 0 and 100 from its measurements of the speed and changes in the instrument's price movements. It should also be noted that when the RSI oscillates above 70, it is indicating the instrument is experiencing overbought conditions. When it oscillates below 30, it is indicating the instrument is experiencing oversold conditions. The Relative Strength Index can also be used to identify the general trend in the market. In an uptrending or bull market, the RSI tends to remain in the 40 to 90 range, with the 40 to 50 zone acting as support. During a downtrending or bear market, the RSI tends to stay between the 10 to 60 range, with the 50 to 60 zone acting as resistance. In all, the RSI is a great tool to help you identify when to enter or exit a trade. The next indicator we're going to share with you is called the Moving Average Convergence Divergence, or MACD. This indicator is a trend-following momentum indicator, illustrating the relationship between two moving averages of an asset's price. To explain further, MACD is often displayed with a histogram that graphs the distance between MACD and its signal line. If the MACD is above the signal line, the histogram will be above the MACD's baseline, or zero line. For example, when the MACD line crosses from below to above the signal line, it is a bullish signal indicating that it might be time to buy. On the other hand, when the MACD line crosses from above to below the signal line, it is a bearish signal indicating that it might be time to sell. It's important to note that if the MACD trading ranges start to whipsaw or move rapidly back and forth across the signal line, a fakeout is likely occurring. Most users generally avoid trading in these conditions and often close positions to reduce volatility in their overall portfolio. Now, let's discuss how divergence occurs with MACD. Divergence is an indication that an end to the current trend may be near, and occurs when the MACD diverges from the security. Divergence between the MACD and the price action is a stronger signal when it confirms the crossover signals. When this crossover occurs, and the fast line starts to diverge, or move away from the slower line, it often indicates that a new trend has formed. The MACD truly is a great tool to help you identify the overall instrument trend in the market. Another great indicator to use is the Bollinger Bands. Successful traders use these to measure volatility in the market. John Bollinger developed Bollinger Bands in the 1980s as a way to gauge the volatility of a market, as well as identify potential entry and exit points for trades. It was constructed starting with a simple moving average, then plotted bands to standard deviations away from this. Since the distance of the bands are based on standard deviations, the bands alter based on volatility swings in the underlying price. Bollinger Bands consists of three lines: the middle line, which is a simple moving average SMA, and two outer lines, known as the upper and lower bands. These bands expand and contract based on the market's volatility, helping traders to visualize price movements and make informed decisions. When the bands narrow, the price is experiencing low volatility. When the bands widen, it is undergoing high volatility. Additionally, during periods of low volatility when the bands tighten, the likelihood of sharp price movements in either direction increases. It is something to watch because this could be indicating the beginning of a breakout or a price movement trend. Keep in mind to be careful for false moves that are in the opposite direction. These are actually reversals before the proper trend begins. Another thing to be mindful of is when the bands separate by an unusually large amount in distance. This can mean that volatility is increasing, and any existing price movement trend might be ending. A strong trend continuation can be expected when the price moves outside of the bands. However, if prices move immediately back inside the band, then the suggested strength is negated. To sum up, Bollinger Bands can be a great tool to help you identify when you might enter or exit a trade. The next indicator we'd like to share with you is the Fibonacci Retracement tool. Profitable traders use this tool to identify target price objectives for the potential levels of support and resistance in the market. These will be the price targets where possible reversals may occur. Charles Dow, Ralph Elliott, and others developed the Fibonacci tool with an understanding that market prices retrace a predictable portion of the previous price movement before changing direction. To implement the indicator and establish the retracement's levels, first, start by drawing a trend line between two extreme price points. From this, the indicator will calculate a series of 6 horizontal possible retracements, or Fibonacci levels, that will intersect with the trend line. These include 0.0%, 23.6%, 38.2%, 50%, 61.8%, and 100%. Thus, you can see that applying these percentages to the difference between the high and low price for the period creates the set of price objectives to watch. Depending on the direction of the market, up or down, prices will often retrace a significant portion of the previous trend before resuming the move in the original direction. These counter-trend moves tend to fall into certain parameters, which are often the Fibonacci retracement levels. The Fibonacci retracement is a great tool to help identify both potential entry and exit points in an instrument's price. Lastly, we will share the Stochastic Oscillator. This indicator measures the momentum of a currency pair by comparing the closing price to the trading range over a certain period of time. It helps you identify overbought and oversold conditions in the market, and can also be used to confirm trend direction. The Stochastic Oscillator is displayed as 2 lines. The main line is called %K. The second line, called %D, is a moving average of %K. The %K line is usually displayed as a solid line and the %D line is usually displayed as a dotted line. The indicator can range from 0 to 100. Generally, the area above 80 indicates an overbought region, while the area below 20 is considered an oversold region. A sell signal is given when the oscillator is above the 80 level, and then crosses back below 80. Conversely, a buy signal is given when the oscillator is below 20, and then crosses back above 20. 80 and 20 are the most common levels used, but can be adjusted as needed. Keep in mind that the stochastic indicator can remain above the level 80 or below level 20 for long periods of time. So just because the indicator says overbought, doesn't mean you should blindly sell. The same thing if you see oversold. It doesn't mean you should automatically start buying. Many Forex traders use the stochastic in different ways, but the main purpose of the indicator is to show us where the market conditions could be possibly overbought or oversold. So there you have it. These are some of the best free Forex trading indicators to help you succeed in the market. Remember, these indicators are just tools, and it's important to use them in conjunction with your own analysis and strategy. Thanks for watching, and don't forget to subscribe to our channel for more great tips and tricks for Forex trading success.